The second is you have to embrace the nature of what you're doing, which is it is about taking risks. And the further out on the risk curve you are, the odds are that there's the risk of capital loss. And if you don't know where you are out on the risk curve, you shouldn't be there. And you need to understand that. And you need to take complete 100% responsibility for all of it. And if you can't, don't be in the arena. Take your money, stick it into an index fund, just go home. Because this is a tough game. And most people lose at this game. I remember, November of 21, markets were just ripping. And I remember saying, it's time to start de-risking and trimming. And the reason was because I saw Bezos and Elon start selling. And I thought, well, these guys are the two best capital allocators in the world today. And so if they're selling, I should sell. I sold a little bit, but I didn't sell nearly enough. But now I've created room in my mind where the people that I think are just structurally and fundamentally smarter than I am, when they do things that are against the grain of what I've done, I immediately say to myself, I need to do the exact same thing. Now prove to myself why I shouldn't, number one. And number two is I can now see when things are just materially different. Wars, rates, commodity dumps, these are things that just have shapes now that I can see a little bit more clearly because I've lived through it. And that's when, again, I have to just re-underwrite everything. I go to the point of everything's wrong. Why do I keep these positions? But I only learned that by, torching $5 billion. It's brutal. I barely survived, but I survived. Were you too greedy? Were you too short term? Did you think it was a safe investment and you oversized it, but it actually turned out to be a much riskier investment and so you had too much money in it? What was the reason why you made the mistake? And then know that all of that money will come back to you if you can course correct that decision. I think that people think investing is a get-rich-quick business, and it's not. It's a get-rich-slow game. It's an infinite game. It's a game that requires unbelievable amounts of patience. Every time that people want get-rich-quick schemes, they stop thinking for themselves. They start looking for answers from others. They invariably blow up and then they blame others. Don't do that to yourself. You are responsible. So don't make decisions you can't justify as your own decisions. I think the most important part of investing is what the goal is. When you're young and the risk of ruin is low, you have more freedom to play for very large upside. When you're older, probably want to make sure you always fade the risk of ruin because starting over is exceptionally hard. So then as a younger person, you can generally take more risk. As an older person, you probably want to take less risk. As a younger person, you can then be more concentrated in fewer things so that if you do your work correctly and those things really explode, you absorb the positive entropy of those changes inside your portfolio. When you're older, you want to make sure that you're position sizing in such a way where there is nothing that could blow a hole in the portfolio. Now, instead of saying old and young, you can also reframe this in terms of your personality. There are some people that, independent of their age, much prefer to be far out on the risk curve. They are fine dealing with the vicissitudes of the market. Then there are other people that just can't deal with it. And those people just need to be highly diversified. And so I think part of it is knowing yourself and then also knowing your stage in life and your goal. And if you know those things, then you can do portfolio construction properly. For me, I think of my life as a barbell, where on one end of the barbell, I have the overwhelming majority of my capital in extremely concentrated, highly asymmetric bets on technology. And then on the other side, I have it hedged with what is effectively cash. People ask me a lot, like, why did I invest in the Warriors? I was one of the 6 or 7 people. We pooled our money. We bought the team. I own 10% of it. I bought 10% for about $25 million, which today feels like a steal because that 10% is now worth, I don't know, 6, 7, 800 million, 900 million probably. I sold it for 500, but why did I do it? Because I was like, well, I need to structure my risk barbell. I'm going to go out here on the risk curve and make a bunch of concentrated bets in technology companies. They could all go to zero. And I don't want to start my life from zero So worst case, I'll have this $25 million investment that I thought at the time would effectively be totally uncorrelated to tech and effectively compound at the rate of inflation. And I thought, what's the most uncorrelated thing to technology? The best I came up with at the time was sports, professional sports. So even if that asset didn't appreciate, I still would have felt like I did the right thing because it gave me the mental freedom to then go and build my investing chops in technology.